This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and this is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel and check to see if, largely speaking, things are still going according to plan. So as ever, we're going to run through this thing from the top. I don't think we did one last weekend, which means there's a few new pieces of data we can check in on and again use that to see if things are still going, largely speaking, according to plan. So without further ado, for the stocks, the base case was at the lows. We were too bearish. We'd have a blow off top to all-time highs and then come tumbling down in a global bear market and recession. And here's the key part, that this global bear market and recession would have a deflationary component to it. Fast forward to today, I was making the case that we had completed 3 blow off top angles, we had broken down from the third angle and the second angle, we confirmed this with a failed daily cycle, and thus I was saying that any counter trend bounce here would most probably lead to a lower high and then a rollover and a continuation of downside. But I was very clear, as you can see from my prior squiggles, that we first have to see a daily cycle low and give the market a chance to prove itself that it wanted to perhaps move higher. So I've been operating with the assumption that we would most likely see new lows here. However, I did want to be long just in case I was wrong and we were going to invalidate this top call setup. Taking a look at where we are today, you can see we found a daily cycle and we seem to be pushing up. Now, I am long just in case this thing moves to new highs. I'll show you the positions at the end as always, but we finally have a very clear invalidation for any bullishness. All the while this cycle low holds, as you can see by this yellow horizontal line right here, all the while we're above this level, then it's malpractice to be bearish at this stage. The moment, however, we trade down and fail the cycle, it becomes malpractice to be bullish. So for now, long and strong, let's hope we can see new highs. However, the moment this cycle low fails, to me, all it does is confirm that this indeed was a lower high bounce. The top call from back here in January was correct, and therefore it's only reasonable for me to expect continuation of downside and ultimately new lows. Again, though, let's be really clear, I can only continue to adopt that posture having seen a failed daily cycle, which so far we do not have. So for now, long and strong, cautiously optimistic. If we're going to be super bullish about this, then perhaps something akin to this is on the cards, right? Have we just completed the bear trap before a final blow off top? I think this would be the most extreme bullish scenario. And just in case something like this is in play, that is why I'm currently positioned long. But again, it's a very cautious long, and any kind of left translation and failure into the cycle low will see me flip net short. For Bitcoin, we've been working with the assumption that we were going to find another weekly cycle low. And as you can see, every other weekly cycle low has led us to approximately a double off of that low. For a long time, I was saying we should probably get a low in here and then see, roughly speaking, a double from wherever that low forms. To get a more updated look at this chart, you can see right here, so far so good, right? Pushing up about halfway through the bullish portion of this weekly cycle, looking for approximately speaking a double to around 150k, which would be roughly 2x from where the ultimate low at about 74k formed. So for Bitcoin, I think the read is much more simple. We're currently bullish, and until such time as we start to break down, then we remain long and strong there as well. As I said at the start, the one key component of this bear market, should it unfold, is I expect to see a short period of asset price deflation. And that brings me on to the next component of this hypothesis. And that's simply because anything you do to the MT rate of change shows up in the CPI with a lag. I was saying since we went down, sideways and down, we would see the exact same thing here, down, sideways and down, and ultimately we would slip into a short period of asset price deflation as a result. Here's a more updated look at this chart, as you can see right here, well on our way to that final push to the downside and a brief slip into deflation, if you ask me. The trueflation as well, of course, has had plenty of counter trend wobbles, but ultimately the trend remains down. So for me at least, so long as this continues to move to the downside, I can continue to accept that the risk here is deflation rather than the resumption of inflation. Of note, I think it's possible that due to the one-time price hikes that we've seen from the tariffs, we've got a little bit of a wobble here. But remember, the key component of tariffs is that they are not inflationary. To have inflation, we need to have consistent back-to-back price increases. Tariffs are more of a one-time price hike, which is more akin to a tax. And thus, I still maintain the risk here is deflation, and that will continue to confirm so long as this continues to move to the downside. We've got some new data here in the form of PCE since I've done the last weekend's deep dive. This is quite a long thread, but I'm just going to pick out the key details here. Headline PCE is only 1.2% annualized, and the second straight month of sub 2% annualized figures. Over the past 12 months, headline PCE printed at 2% annualized or less 8 times, meaning only 4 months were above the Fed's target. So you can see here, Fed's target 2% PCE, and we've spent the majority of the time below that. Hard to make the case that inflation is sticky or inflation is a problem based on this. If we take a look at the data back from Jan 22, Headline PCE year over year, clearly in a disinflationary trend, clearly, if you ask me at least, on its way to that brief period of asset price deflation. We observe a similar trend with core PCE, which, by the way, remains only about 47 bips above the Fed's inflation target. So this is slightly more than headline PCE, but certainly moving in the right direction by making new multi-year lows. PCE core services excluding housing month over month, again, showing early warning signs of a deflationary look here as well. Okay, so I continue to make the case that my call on inflation is correct and that the risk here remains deflation rather than a resumption of inflation. The next part of this assessment is that if we're going to have a global bear market and a recession, then it's only reasonable to expect to see the labour market deteriorate. And that is, again, what we have been seeing. Now, again, as is the norm for the past couple of years, the jobs data becomes increasingly complex to navigate. There have been lots and lots of revisions. Non-farm payrolls on Friday came in slightly above expectations and was used to explain away the upside price action from the cycles. Where I really put the majority of my focus is on the unemployment rate, which again is consistent and steady at 4.2%. And again, I am here to warn you that whilst the current narrative, just like it was a while ago, that inflation is sticky and we're going to do that 1970s inflation fractal repeat, and I kept saying, no, the market is wrong about that. I maintain the market is wrong about this as well. Whilst people think unemployment is still a historically low rate, this is absolutely false. 5 out of the last 12 recessions started with an unemployment rate of 4.1% or lower, and the 1954 recession started with an unemployment rate of just 2.6%. Meanwhile, when we take a look at things like U6 continues to show that lead-in phase before acceleration that we see in all prior instances of recessions. So unless this thing can reverse and start to break structure, unless this thing can roll over and start to make new lower lows, then I still say that we are continuing to witness labour market deterioration in real time, and this will eventually set up a recession. You can see that when we take a look at the updated version of U6, okay, nominally moving to the downside, but certainly not enough to make this chart feel much better. It still looks an awful lot like a lead-in before acceleration, at least at this moment in time. Now, it can change. I would love to see it change. I'd love to see it roll over. I'd love to come here next weekend and report that it's printed a new low. But at the moment, that is not what we've got. And that exact same lead-in before acceleration applies to the SAM recession rule, which, by the way, has just had another print at the exact same level for 3 months in a row. So 0.27 was the current print. At the moment, what we have is a lead-in before acceleration, just like we had in all prior instances of recession. And again, I sit here and say, I would love nothing more than to come here 1 week and say, that's it, we've got a new lower low, we've broken market structure, maybe we can take the risk off the table pertaining to this indicator, same as what I was saying with the U6. But objectively speaking, we are still yet to print a lower low, we are still yet to change the market structure, and thus, this is still, objectively speaking, a lead-in before an acceleration to the upside, which of course is synonymous with recessions. So for now at least, I'm going to say that until such time as we see improvement in the labour market data, then I believe we still have labour market deterioration, and thus I'm going to tick this one off as well and say that this is also still going according to my expectations. And this is the main reason I continue to beat the same drum about the interest rates held by the Fed at the moment being overly restrictive. Since we know that inflation based on PCE is already at the Fed's target, we know that the CPI inflation data is in a heavily disinflationary trend, and we know that the labour market is not yet showing any signs of improvement. Having interest rates this elevated, to me at least, speaks to this being overly restrictive. Moving on to the high yield credit spreads and the yield curves, which we use as alarm signals to confirm breakdowns off a real in the stock market, we did have a bit of a wobble here, as you can see at the hard rate edge. We had a breakout. So far though, not quite looking like it wants to pop up yet. Now, if it does, to me, breakout, retest and resumption would be a sign of financially stressed conditions to come. And especially if this is to occur with the stock market making a lower high, rolling over and failing the cycle, then I would be 100% confident that the top call was correct. This is just a lower high bounce and we are going down towards new lower lows. However, if you're a bull, if you're a stock market bull here, you want to see new highs and you need to see the yields come back under here and trade in a range. So we'll review it next weekend as well, and we'll see whether we've got deterioration or improvement. For now, at least, we have to continue to take this one day at a time. And for the yield curves, we also use this in a similar fashion. I often say that people get this wrong all the time. When this thing inverts, everyone screams recession, and they're wrong. When it reverts back above zero, everybody thinks that there's a recession coming, and again, they are wrong, because it's the acceleration to the upside that usually marks the top is already in for the stock market. So of course, the big question is, have we got improvement or deterioration in the yield curves? To me, it looks like we haven't made a lot of progress. So no progress is good. When it comes to the yield curves, we do not want to see the continuation of higher highs and higher lows on the weekly time frame. It looks to me like it's thinking about breaking down here. Now, anything other than an accelerative sweep here, coupled with a stock market rolling over and failing the cycles, I can say is pretty bullish. But if we do start to get acceleration here, particularly without making a new all-time high, and particularly if it is coinciding with breakdowns and failed cycles, then we have to accept that the top is in, the top call back here is not yet invalidated, and new lower lows are on the way. So you can see we're very much open to all possible outcomes. We're still positioned to the long side in case we're going to be able to invalidate this setup. But again, as the level 3 members know, we are getting ready to go short if we start to see any kind of breakdowns here, coupled with things like the acceleration in the high yield credit spreads or the yield curves. If I sharpen this yield curve by changing it from the 10-year, 2-year to the 10-year minus the 3-month yield, what you'll notice is we have, again, the first glimmer of hopes here. We are chopping in a range, we're going sideways. This does not look like an accelerative sweep. It doesn't look anything like what we saw back here during the C19 meltdown. It doesn't look anything like the accelerative sweep during the GFC or the dot-com bubble burst. So far, things are showing the first early stages of improvement, allowing us to perhaps see new highs in the stock market. But again, as you can see, it's not going to take much for things like the U6 unemployment rate to start to put in an accelerative push to the upside. It's not going to take much to see the SAM recession rule pop to the upside. It's also not going to take much to see these high yield credit spreads complete a breakout retest resumption. And if all of this is occurring against a backdrop of the yield curves making accelerative sweeps to the upside, with the stock market confirming breakdowns and failed cycles, then we do have to be able to be objective here, pivot to defense, and start to look to protect the gains that we've made ever since we've had this channel by calling the lows and staying on trend for most of it. So to be clear, I'm operating with a cautiously optimistic posture. I am still long until we see some breakdowns and failed cycles, and if we don't, then we will continue to stay on trend and capture the meat of the move as we always do. But whilst we have been in a buy the dip environment the entire way up, I think finally now we have the first early warning signs of potential deterioration, technical damage, and again, based on all the macro data that I follow, the risk here is deflation and downside, not a resumption of inflation and a continuation of big rip-roaring bull market. In either case, we're going to do fine because we always manage to position ourselves in a way that we can profit from all circumstances. And that brings me on to the TA section at the end. So out of this most recent daily cycle low, we are long the stock market. Again, we've got a hard invalidation set, and any kind of left translation cycle failure here will see me pivot net short. We were able to capture a whole heap of dip buying during this spill. I was jumping up and down and screaming contrarian. We added things like the Russell 2K, semiconductors ETFs, a whole heap of crypto equities like TerraWolf, Riot, Coinbase, MicroStrategy during this spill. So we're comfortably sat in profit from the longer term accounts. The shorter term accounts, which is things like this, we've got our trades with our invalidation set. For MicroStrategy, we are also sitting in profit on this trade. So we did plenty of dip buying, and it's really just a case of making sure everyone understands that this is the level we must not trade, okay? Trade below this cycle low, and it really is over. And that's not to be a doomsayer or anything like this. This is just simply to have a technical level on the chart in which we can say, okay, trade below there, and that confirms all of this is just a counter trend bounce before the primary downtrend resumes. And of course, similarly, if new highs are on the table here, then we are positioned to capture that. For gold, we're still positioned out of the most recent daily cycle low. If I turn my indicator on, we know we're on our way to another daily cycle low soon. So if you've been missing out on this move, then you can of course use the daily cycle low to get to full exposure there. We've done really well in the member section for capturing a bunch of the miners and individual mining stocks, ETFs, that kind of thing out of this weekly cycle low down here. Things like SILJ have been printing in both the longer term and shorter term accounts. So we've done well to capture this move, but to say that we're not in an area of potential inflection point would simply be malpractice pertaining to capital management. As for Bitcoin, working on perhaps a swing low and a reversal, I'm looking for a trendline break here to add a short-term trading position and target that move from about 105k to 150 plus k. And the interesting thing about this current push is once we get up there, I think for the first time since the core allocation at the lows, I'm going to be looking at unloading some of my spot position into this current top. So we'll see how it goes. For now, I just just need to see this thing confirm and break a trend line, and then again in the level 3 member section, we'll add another supplemental Bitcoin trade in the short-term accounts. We'll add a couple more of these crypto-related equities, and we will see what the market can give. So I'm your boy Camel. I hope you're doing well in life. If you're a level 3 member, look out for the members only video I'm about to post for you guys. And other than that, we'll be back next week with more daily content. So until then, take care. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a bad